Today, Vulcan Energy did a cap raising and it actually increased in share price, which is something that's very unusual. The name Gina Rinehart comes to mind in reference to why this stock price may have risen today. And what I want to do is I want to cover the fundamentals and do a comparison between this company and another lithium brine company that's been quite successful, and compare it to about 2 years ago. So we'll do a comparison between Vulcan Energy and Argosy Minerals, but before I start, let's have a look at a 30-second introduction as to what Vulcan Energy does.
Here's how it works. Lithium-rich geothermal brine is pumped to the surface at 165 degrees Celsius. The heat from the brine is used to produce renewable geothermal electricity, which gets sold into the grid. Energy from the brine is then also used to drive a lithium extraction process. Lithium is taken out of the brine, and the brine is re-injected back into the geothermal reservoir. A lithium hydroxide chemical product is produced to be used in batteries for electric vehicles. Ultimately,
that pretty much sums up the company. Now, Argosy was a similar company to Vulcan Energy, except it's not a zero carbon footprint producer. At least I don't believe it is. Vulcan's aiming to be the first as far as I understand. However, this is where Argosy was at roughly the same time when there was a pre-feasibility study. And it had a bit of a pump. Lithium was on a pump as well. Let's take a look at the lithium price. It was on a huge surge. It was 171,000 CNY per ton. And then it tanked to about 40,000 and just recently rose to 67,000. So there's a resurgence in demand for lithium. I know, guys, this is lithium carbonate, not lithium hydroxide, which is what is being the focus of Vulcan Energy. However, if we take a look at the price of lithium carbonate versus lithium hydroxide, they seem to move in tandem. So we've got a couple of comparisons here, and they seem to move pretty much the same since 2018, all the way through 2019, and of course to 2020 as well. So what we have here is Argosy. It was starting out, it had a nice pre-feasibility study. And just to give you guys some context, it took these guys about 2 years to send out their first shipment of lithium. So this is what it looks like. We've got an initial FOMO phase. There's hype and excitement around the company. And then of course it dwindles as the price of lithium also dwindles as well. So there's also a lack of interest because it takes time to build the mine. I can't emphasize this enough. Pre-feasibility study is one thing, feasibility study is another, doing a JORC as well, great, but then you actually need to develop the thing. And interest wanes. The companies lose interest, or rather investors lose interest as this production's happening because nothing's really interesting. It's just being developed, and of course lithium in this time has been dropping. And we suddenly have a resurgence as of late because of the lithium price as well. And of course, there's other things going on behind the doors for Argosy. You know, they're looking to ramp up production from 2,000 tons per annum to an extra 10,000 tons per annum. So there's things going on for Argosy, but I want to highlight that this phase in Argosy is the hype phase. This is where people get really starry-eyed about the future of lithium, the demand for it, and where it could be. But what they fail to realize, at least people who invest in mining companies, is fail to realize that it's going to take a couple years to actually develop the thing, and not much is going to really happen in that time. So before I go any further, I just want to say that I'm not a financial advisor, and you should not take this video as financial advice. Consider it as education and entertainment purposes only. Nor am I recommending to buy or sell Argosy or Vulcan Energy today. I'm simply covering a comparison between the two companies and what can potentially happen in the future based on the history of another company. And in this case, that company is Argosy that we're looking at here on the charts. So I did a spreadsheet as well. Real quick, here's the chart for Vulcan Energy. Did a nice pump. But a perfect 61.8% retrace from the beginning of the momentum swing to the upside. 61.8 to 38.2 was a perfect trader. It's doing really nicely on the charts. It's holding up. It's consolidating in this range here between 678 and 961. And I would expect another swing to the upside purely based on this comparison here. What we're looking at is the comparison between the tonnage and the concentrate between Argosy and Vulcan, what we have is a significantly larger tonnage, but half of the concentration. So I think it'd be a relatively rough and somewhat fair assessment if I was to double the tonnage here and half the concentration. So that way we have some sort of like for like comparison. I know that's not how it works in the real world, guys, but just a rough, crude estimation. If we were to say that this had 415,000 tons, and this had 181 milligrams per liter. And please do hit that subscribe button if you do find this content helpful. Now, what we have is a peak market cap of 432 million when it had a SOI, shares on issue, of just under 1 billion shares. So I want to reiterate this point as well to newer investors. Share price means nothing. 16 cents and $9 doesn't mean anything. What matters is the combination of the shares on issue with the share price to get the market capitalization. What matters is market capitalization. A stock can be valued much higher. Let's say a $1 stock can be significantly more higher value than a $10 stock, right? It depends on the shares on issue. So you must multiply shares on issue by the share price to get the market capitalization. So what I have here is the peak of Argosy at 432 million. That was the absolute hype moment. This was the initial pump, similar to what Vulcan's going through at the moment. Vulcan has a relatively consolidated phase into a pump. Not too dissimilar from Argosy. We can see here there was a pump consolidate into a massive pump, and another consolidation phase, which is what I believe might be happening at the moment based on the phases of mining. And this is typical of mining cycles. If we look at the market cap comparison, based on the tonnage, we can see that there is roughly there's roughly 3 times more tonnage, assuming the same concentration. And we're going to take a look at the life of mine comparison as well. So life of mine, I believe, was initially 10 years. It got upgraded to 16. Initially, it was 2,000 tons per annum. Sorry, it was 500 tons per annum, upgraded to 2,000 tons per annum very shortly after. And then as of like maybe the last year or so, they upgraded to an extra, or they were looking to upgrade to plus 10,000 tons per annum. Now let's go through Vulcan Energy and go through their feasibility study or pre-feasibility study and the documentation we have here of the tonnage and the life of mine. So these guys are looking for 30 years on both production forecasts that they have. And we're going to go through and see that they have 7.5 tons per day times 365, assuming it runs every day. And that is per doublet times 9. So 24,000 tons per annum. Or we have 701,409 divided by 30 years. So roughly the same number, 23,000 tons. And then we have the other site. We go the correct way. We also have this site here, Taro production forecast. We're looking at 7.6 times 365 days in a year multiplied by five doublets that they have. So 13,000 tons plus with 23,380. So we have a total of 37,000 tons, which is quite a bit more than Argosy. So we have production target of 37,500. See, at the current phase, we're sitting at a market cap of 700 million. And at the peak was 432 million for Argosy. So Argosy at its peak, it added on about another just under 100%, let's say 80% on top in the move that it made. Now, I'm not suggesting that Vulcan is going to make 80% gains from this point in time. Another upswing is possible. So if we go from, let's say, $8.50, which is the midpoint of that range, multiplied by, let's say, 1.8. So there's potentially a $15 target, perhaps a little bit higher, $16 target for a breakout should it occur. And it's really interesting because we now have more interest in the stock because of the announcement. We have a capital raising $120 million institutional placement, and it went to Hancock Prospecting, was the cornerstone investment. And it is led by the executive chair, Mrs. Gina Rinehart. If you guys don't know who Gina Rinehart is, just Google her. She's extremely wealthy, extremely successful in iron ore and in, I believe it's coal as well. So we have a look and we can see there was a 17% discount from $7.84, which is the last traded price. And the stock went up. Yeah, the stock actually went up to $9. So it's from $7.84, gapped up to $9 and rallied to $9.60 today. So there is clearly an interest, despite the fact that the cap raising was somewhere down here in the $6 range. That's unusual, guys. You don't normally see this, right? Capital raising is seen as kind of a necessary evil for the ASX, for especially miners, right? They need capital because they're not making money at the moment. So these guys, they do capital raising because they have to get the capital in order to build the infrastructure to get to the point where they're making money. So what happens typically is a cap raise will cause the stock to go to the cap raise price or very close to before rallying or before recovering and returning to normal price. However, I think the market confidence of Gina Rinehart buying into the stock, I don't think you could ask for a better name in mining to hop in on the stock. I don't think anyone expects her to just flip the position because she's kind of, an investor in the mining space, one of the most well-known people aside from perhaps Twiggy Forrest. They're obviously the two biggest names in mining in Australia. So that's the situation we're in at the moment, and we can have a look at the financials just real briefly to see where the situation is financially for the company. So here's a quarterly cash flow report. Let's have a look where they are financially. These guys burn about $450,000 a quarter. Previous quarter, or rather year to date, $855,000. So they're roughly burning at the same rate per quarter. And these guys have $5.8 million in the bank. That's excluding the capital raising of $120 million. So these guys are now in a very strong financial position. What I expect is another swing to the upside, and you guys can make your own estimations and calculations in comparison to Argosy as to where this stock could go. I'll leave that assumption and calculation to you, but the data is here if you want to make the comparisons. I'm not going to do it because these are two different companies, but it's worth noting the similarities that these companies are doing lithium brine in different ways. But do keep in mind, I do expect this to take maybe 1 to 2 years for lithium brine to really come into full effect and to actually ship out the first amount of lithium. So do keep that in mind, guys. You actually have to get the mine into production, and that takes time. Lithium brine happens to be one of the quickest minerals to get into production. If you're looking at a mine for gold or silver or something, it could take a couple years, 2.5, 3 years. Whereas something like lithium brine usually takes half the time. It's a lot quicker to get into production. So do keep that in mind. And do keep in mind that the euphoria is likely to come back to reality. Do keep in mind the stages of mining. These things have to happen, and when these things do happen, they're de-risked, but also the euphoria phase, that interest and hype, does dwindle as well. So do keep that in mind. And if you learned anything today, if you found the comparison interesting at all, feel free to hit that sub and hit the like button for me. I'd appreciate that very much. And have a good one, guys.